FTSE Group and Frank Russell & Co. merged last year in a $2.7 billion deal. The two combined is one of the largest index provider in the world. We are delighted today to have with us Mark Makepeace, CEO and founder of the FTSE Group, who will share his insights into some of his priorities for the coming year, including expansion in North America, China, and into the fixed income market. Let's have a listen. Mark, what are your priorities following the merger of FTSE and Russell?
Priorities have been consistent for a number of years now. North America, which the acquisition of Russell was an important part.
That's right.
Now we have to bring that together and work with the clients across North America.
Yes.
And we're looking to, use the Russell clients who were using Russell for their domestic benchmarks to use FTSE for their international. So it's cross-selling into that client base. So North America, priority number one. Priority two is China. We've been in China since 2001. China is getting more and more exciting as it gets close to being included in the global benchmarks. And a third big priority is fixed income. We are rapidly growing the fixed income indices we have.
When you look at all those moving parts, what would you see is the greatest opportunity for you?
I think the immediate opportunities are China and North America. They're the immediate. I think the medium-term priority is fixed income. I think it's a very sizable market that's going through huge change today.
Tell us about the strategy that you want to move forward in terms of achieving your goals in North America, in China.
I think what our clients are telling us is that, and these are large institutional investors, they're the pension funds, state funds. These people are telling us that what they want to do is they want to have a much greater use of indices and passive funds. They're going beyond using this for just equities into fixed income. They're talking to us about multi-asset benchmarks. They're talking to us about factor approaches or smart beta. Because they're trying to do two things. They're trying to reduce the cost of investment to them.
That's right.
And they're trying to increase their transparency so they can actually see what they're holding and what their exposures are.
You touched on something that's very interesting, this ongoing debate between active and passive strategies. And I know that you have a point of view given the fact that today up to 30% of UK US funds are in the passive and then 70% are active. Where do you see that going into the future?
One of the fastest growing areas is smart beta.
Yes.
We would look at that as factor-based investing. And active managers have been looking at factors and investing on a factor basis for a long time.
Yes.
I think what's happening now is that the big institutional investors can realise that if they can replicate these factors as indices, they can reduce their cost. And that's what's challenging the active managers.
So they're getting a free run at the moment.
We're in an environment which is low yield.
That's right.
So the more you can do to reduce your costs, and at the same time increase your transparency, that's a good thing.
Yes. Smart beta is an interesting subject. I know that you did quite a comprehensive study, and I know that in Asia, that hasn't really taken off. We're at the beginning stage of that. Can you share with us what do you see into the future?
Well, the levels of indexation in parts of Asia is also low.
Yes.
It tends to be a very active-based market, and I can understand why, because Asia is many markets, and often you need a deep understanding of those markets to understand the opportunity. But I think passive investing, is growing.
Yes.
I think smart beta gives people the opportunity to pursue these opportunities, but do it at a much lower cost. So I think Asia will catch up, and I think as China opens up, as China market matures, these approaches will benefit that market, but I think it will also be of great interest to investors.